US inflation fell more than expected to 2.8% in February, helping the case for the Federal Reserve to cut interest rates amid signs of slowing growth in the world's largest economy. On a monthly basis, CPI rose 0.2% after 0.5% increase in January. The core CPI, which excludes volatile food and energy prices, rose 3.1% year-on-year, also less than 3.3% increase in January and below estimate of 3.2%. On a monthly basis, the core CPI rose 0.2%. Hello, welcome to Global Business Insights, where we look into the main business stories, and our deep dive is on the latest inflation data from the world's largest economy, the United States, and the implications. But first, some of the other headlines. The NASDAQ composite rose yesterday, closing positive after a soft inflation report eased concerns about the economy and as investors bought into the dip in technology shares. US stock futures also held steady. On tariffs, Canada yesterday said it will impose 25% tariffs on more than $20 billion worth of US goods in retaliation for the Trump administration's steel and aluminium duties that just took effect. Canadian Finance Minister Dominic LeBlanc says the new tariffs cover steel and aluminium as well as other US goods including computers, sports equipment and cast iron products. While the EU also announced retaliatory tariffs, the UK says all options are open as it weighs next moves. Amid ongoing uncertainty in global markets, oil prices yesterday moved up 1.94%, supported by the weaker US dollar. The Brent crude standard was over $70 per barrel as the market tightened with a lower forecasted surplus. Prices are still expected to remain sensitive to external developments. Crude oil inventories in the United States saw an increase of 1.4 million barrels during the week ending March 7, according to the latest data from the U.S. Energy Information Administration, that's the EIA. This was after the American Petroleum Institute API reported on Tuesday a build of 4.247 million barrels in U.S. crude oil inventories amid strong product draws. The EIA now expects the global market to be in 100,000 barrels per day surplus in 2025, compared to a previous forecast for a surplus of 500,000 barrels per day. The oil market seems to be largely ignoring the possibility of a US-brokered Ukraine-Russia ceasefire given the uncertainty over where Russia stands. European Central Bank President Christine Lagarde said yesterday that they cannot ensure that inflation will always be at 2%, but she added that they must still set the monetary policy so it converges as close as it can towards 2%. She added in a speech that trade fragmentation is also likely to lead to larger, more disruptive relative price changes. This was as another ECB Governing Council member, Gedimas Simkos, said that it remained irrational to commit to future rate decisions. As Tesla navigates a brand backlash from Musk's affiliation with the Trump presidency, investors are trying to understand the damage and whether it is permanent. And indeed, analysts do not have a precedent to guide their response to the reputational damage over the last few months, which is on a scale which has never been seen before in the automotive industry. Geopolitics has roiled auto markets before, but at a different level. Hyundai, for example, took a hit in 2017 after Chinese citizens boycotted the brand to protest over South Korea's decision to deploy a US missile defense system. Tokyo and Nissan, among others, slashed production in China after anti-Japan protests over disputed territory closed dealerships and slammed sales. For Tesla, the hit has been across several geographies. Sales in Norway and Germany have sunk over the past few months, partially due to Musk's political interests. In February, Tesla's Chinese shipments plunged by 49% to 30,688 units, its lowest monthly figure since July 2022. In California, traditionally Tesla's biggest domestic market, sales sank for 5 straight quarters. So it's all about the combination of a broad market slump in the auto market, complicated by the Trump backlash, which is coming at the worst time. The U.S. Federal Trade Commission is moving ahead with an antitrust probe of Microsoft that was opened in the waning days of the Biden administration, signaling that the administration FTC chair Andrew Ferguson is going to prioritize scrutiny of tech giants. In his first public remarks since taking the chair position in late February, Ferguson said investigating the tech sector is his highest priority. Early moves include seeking information on censorship by tech companies and wanting to understand how their recent investments hurt competition. India's inflation rate in February fell to a lower than expected 3.61%. That's in February as vegetable prices cooled, also lower than expected 3.98% for the period. It was also the first time in over 6 months that inflation has come in below the Bank of India's target of 4% and the lowest print since July 2024. Speaking of the importance of data, the website of the Nigerian National Bureau of Statistics is back, but the data calendar is not populated. Normal practice is to have all the data to be released at least for the next quarter and on the calendar, showing not just dates but time of release. But rebased GDP data we also expect to see next month, and hopefully some of these other issues will be addressed. In South Africa, the stage is set for a fierce parliamentary debate after Finance Minister Enoch Godongwana tabled a budget that backed down halfway on the VAT hike he proposed last month. The revised budget proposes 2 half percentage hikes over 2 years to lift the VAT rate to 16%. The budget, however, delivers on the promise to stabilize the public debt ratio in 2025-2026, though this will now peak at 76.2% of GDP, up from the 75.5% estimated a year ago. It also reduces some additional spending, mainly through smaller increases to social grants, but it's still being criticized for not cutting enough spending on several wasteful programs. And in the US, as inflation cooled, stock futures were up in response as the figures raised expectations that the Federal Reserve would pursue more aggressive interest rate cuts. However, the data predates most of Donald Trump's new tariffs, which have raised concerns that price pressures could rise further. Economists are noting that tariffs will raise U.S. consumer prices and slow the U.S. economy as companies delay spending decisions, and we have Goldman Sachs analysts, for example, cutting GDP growth forecasts to 1.7% from 2.4% at the beginning of 2025. The best case could be a lingering stickiness or an inflation upward blip, as U.S. Treasury Secretary Bessent is saying that tariffs imply a one-time adjustment. Indeed, purchases have been front-loaded, implying a short-term drop in trade as tariffs fully kick in. Like I said in an earlier episode, from the last experience with Trump 1.0 tariffs, inflation did inch up, but not materially so, and not for long, as inflation was more driven, at least then, by demand factors rather than supply. The Federal Reserve is saying it wants to understand the complete demand-supply dynamic around various policy shifts, and especially the retaliation scenarios we are likely to see, including the impact of other interventions such as tax cuts and lower deficits. Others argue that it seems Trump will be quick and flexible to make necessary future adjustments to avoid an inflationary spiral or any further drag on an economy he has campaigned is entering a golden era. For now, it is all more uncertainty, which is weakening sentiment rather than substance, as markets are bracing for a recession in the US. What this means is that this year will be one to stay very close to the data. Still, yesterday's inflation data was seen by analysts as dilutive to the stagflation narrative and, most importantly, restores policy flexibility from the Fed. What we mean is that the Fed will have room to ease should, in case labor and activity data presents weaknesses in economic growth expectations. Other analysts comment that given that US equity markets have been exceptionally strong over the last 2 years, it's right to expect a correction, adding that coming policy shifts like tax cuts and easing regulations suggest better news ahead for equity markets. JP Morgan CEO Jamie Dimon said it's difficult to accurately assess the current state of the US economy, saying the geopolitical uncertainty is the biggest risk right now. Other analysts say the times call for looking and being skilled to find the signals through the noise of the frequently changing tariff policy coming out of the White House. Given the backdrop of volatility and uncertainty, analysts are advising more prudence and staying more defensive than usual, implying that in the near term, treasuries will rally further amid growth scares that seem to be predominating. Defensive trades means preference for safer havens and less risky treasuries over high-yield corporate bonds, and a bias for defensive equity sectors over cyclicals. Having generous cash and liquid buffers than normal also makes sense. The drama is nowhere over, given that we are just in the first quarter of a 4-year ride. But not everyone is bearish. UBS says while market risks have certainly increased, they still have an overall bullish view on the US economy. And their base case remains that the US economic growth can remain resilient, enabling the equity rally to resume, supported by continued heavy investment in artificial intelligence and progress towards its monetization. UBS adds that they see further upside for US equities and expect the S&P 500 to reach 6,600 by the end of 2025, around 18% higher than current levels. It is a year in which investors will need to be extra cautious. The Bank of Canada cut interest rates by 1/4 percentage point to 2.75%, adding that Trump tariffs is causing a new crisis. The central bank, after easing rates 7 times in 9 months, said that a different uncertainty was already hurting investments. Caution needed, they say, as new inflation risks have to be balanced with easing rates to improve growth. In the UK, financial regulators are prioritizing concerns over economic growth and not heaping more rules on companies as they scrapped plans to impose stricter diversity, equity, and inclusion rules. The Financial Conduct Authority also abandoned proposals to publicly identify firms under investigation after industry argued it could damage reputation of companies before proving wrongdoing. Shares of Rheinmetall jumped 6.2% yesterday on Germany's benchmark DAX index. Europe's top ammunition makers' stock has more than doubled within a year as a result of a surge in defense spending expected by European leaders. Asian shares are lower despite the rebound in Wall Street due to cooler than expected inflation. Later today, we will get the latest US producer price index data or wholesale inflation print. Chinese markets also slipped as investors eye the next trade war moves. Well, that's all we can take on this episode of Global Business Insights. We are on BusinessDay TV daily, 11 a.m. West Africa time. Thanks for watching. This is Bode or Shosami. Bye-bye.